A warm welcome to all my viewers. Today I'm in conversation with Dr. Joseph Thomas, Head Research, Emkay Wealth Management. It's a timely session on market perspective. Given the recent fluctuations in global oil prices, what factors do you believe are the primary drivers behind these movements?
Recently, in the recent past, there was an uptick in oil prices. Brent moved up to $92 per barrel levels. That was the time when the geopolitical situation in the Middle East was moving towards some kind of a larger conflict, but now it has subsided. Brent has come down to $82 per barrel as of last weekend. There are two factors which are at play here as far as Brent is concerned. The first factor is that there has been a significant amount of demand destruction in the US, in Europe, and in many countries on account of the very high fuel prices. The demand destruction is still continuing, and because of which people started consuming less of diesel and gasoline and petrol and all that, and number of people taking to the highways also was much lower. So that is one factor which is pulling the oil prices lower, but it is relevant only in the very short term. In the long term, oil prices will definitely have a tendency to go up. I think the geopolitical situation, especially in the Middle East, will remain slightly fluid. That could keep on pushing up the prices once in a while. Otherwise, in the immediate term, the demand destruction factor will continue to be at play. Therefore, oil prices would be more or less range bound. We can keep the range of $80 to $90 per barrel as a kind of a range, broad range for crude oil prices.
Dr. Joseph, what are the implications for global markets if these trends continue?
Yeah, the impact of oil prices is mainly on the price level, which means if oil prices move up beyond, say, $90 per barrel, that will have implications for the price level or for inflation, as far as almost all the major oil importing countries are concerned, including China and India. So if inflation stays high because of high oil prices, the inflation levels will be high, and therefore that may have some impact on central banking policies in the coming months. But we believe that prices would remain more or less range bound, as I mentioned before.
How do you evaluate the current state of fixed income markets, and what opportunities or challenges do you see for investors in this space?
As far as domestic fixed income market goes, there are 2-3 factors which are having a favorable impact on market yields and interest rates. We have already discussed those 2-3 factors in some of our publications earlier also. The first factor is the bond index inclusion of Government of India bonds by JP Morgan Emerging Market Bond Index, then the Bloomberg Bond Index, and also likely inclusion of Government of India securities in some other global indexes also. This inclusion would lead to a good inflow into the local markets, into Government of India securities. As of 31st March 2024, we have already seen an inflow of around $6.5 billion into Government of India securities in India. So the inflows have already started, and the inflows will continue to be there because of the bond index inclusion. That's good for the markets because that will have an impact on the domestic market yields, and market yields would tend to move lower from the current levels. A second factor which we had highlighted earlier was that the Government of India securities issues at the primary auctions will be much smaller in the current financial year compared to the last financial year. Last financial year, the gross issue of Government of India securities was around 15.5 lakh crores. And it will be at least 1.5 to 2 lakh crores lower during the current financial year. It's also worth mentioning here that the GST collections and tax collections have been quite buoyant. Therefore, the primary issues that will hit the marketplace will be much smaller, relatively smaller compared to what it was in the last year. So the supply of Government of India bonds will be lower. A third factor is that we have seen inflation coming down from the peak levels to much lower levels. In India, we have the core inflation at around 3.32%, though the headline inflation is at around 4.85%. So the core inflation has come down drastically. The headline inflation is yet to move down with lower oil prices and lower fruits and vegetable prices in the coming months, especially in the light of a good monsoon that's forecast, a normal monsoon that's forecast, prices could be lower. Therefore, these factors could prompt the Reserve Bank of India to go in for a cut in interest rates. One of the features of the markets today is that the overnight rate or the call money rate is lower than the RBI's repo rate today, and the market has sufficient liquidity at this point of time. So keeping these 3 points in mind, it's possible to make a studied inference that market yields and interest rates will gradually move down. And in such a situation or in such a market positioning, it's better to look at the long end of the curve and buy into gilt funds or direct bonds and put it in the portfolio.
Dr. Joseph, with the increasing interconnectedness of global financial markets, how would investors assess and manage risks associated with cross-border capital inflows?
Yeah. As far as domestic markets are concerned, the reliance on external investors or inflows from overseas investors and the domestic market's reliance on overseas investors has come down drastically. There is the liquidity dynamics has changed completely. If you look at the SIP inflows into the domestic equity markets, it's close to 2.5 to 3 billion US dollars worth of rupee investments that's flowing into the markets through the mutual fund systematic investment plans, which means that the reliance on overseas funds has come down drastically for the markets to sustain at higher levels. Earlier, we used to depend too much on overseas inflows, but that dynamics has changed. Therefore, the risks associated with investments or investments locally or investments abroad has come down quite a bit. In any case, most of the time, one of the risks which investors need to keep in mind is the currency risk. When you are undertaking cross-border transactions, it's currency risk that's more relevant, which needs to be managed properly.
How are precious metals like gold and silver reacting to inflation concerns and the fluctuations in the stock markets?
As far as precious metals go, especially gold and silver are concerned, the price of gold and silver prices have moved up in the recent past, and gold prices in the international markets moved up to around $2,370. Same is the case with silver, also around $27 to $28. So both prices have moved up. Why those prices moved up is because of two, three factors. As far as gold is concerned, there was good amount of central bank buying that has gone into the buoyancy in gold prices, and there has been significant retail demand also, apart from central bank demand, retail demand from China, India. These factors helped gold. In the case of silver, what has already influenced silver prices and which is likely to influence silver prices in future is that the silver has a very, very wide variety of industrial use, and it is also used in solar energy and solar panels. So the demand for silver is likely to be much more than the demand for gold. And on a relative basis, probably silver prices have more room to move because of the industrial use and use in the solar panels. Now, whether it is gold or silver, any significant rise in their prices would be the result of a decline in the US dollar against the major currencies. So the moment the Fed would cut the interest rates, the base rate, it will be an indication that the dollar would gradually start declining against the major currencies. So fundamentally, once the Fed rate cut happens and dollar starts declining, the gold and silver prices could move up from the current levels. As far as gold is concerned, at around $2,370, $2,380, there is very good amount of resistance. In fact, it moved up to those levels, then it retraced a little bit lower. Same is the case with silver at around $27 to $28. Technically, they have broken out of major resistance levels, and we could see both moving up, but on a relative basis, silver prices could move up much faster because of the demand from industry and for renewable energy and all that.
So, Dr. Joseph, in wake of central banks buying gold extensively, what levels do you think gold will rise?
As I told you, the gold prices have broken out of its long-term resistance levels at around $2,000 to $2,050, and it's currently getting resisted at around 2,370.80. So therefore, in more or less in alignment with a Fed rate cut, we could see the levels moving higher in gold.
With the recent changes in the economic landscape, how do you assess the Federal Reserve's monetary policy stance? And what factors are influencing its decisions on interest rates and quantitative easing?
As far as the US economy is concerned, the rate of economic growth for Q1 of 2024 was at around 1.6%, as against the GDP growth of around 3.5% for Q4 of 23. So GDP growth has clearly slowed down, or it's showing a tendency to slow down. When it comes to inflation, the core inflation in the US is at around 3.8%, whereas the headline inflation is at around 3.5%. So inflation has come down, but it is still quite far from Fed's target of 2%. So inflation performance needs to improve, whereas we are seeing on the other side lot of layoffs, especially in tech companies. The earnings results of some of the logistics companies are not very encouraging, which are actually read into as indicators, the first indicators of a future slowdown. And there is GDP growth, which is gradually slowing down. Therefore, the Fed would be waiting to see whether the inflation is coming down further, because they are not happy with the recent inflation performance. But as far as the markets are concerned, when markets would see the GDP number or inflation number or some other numbers including unemployment rate and all that, market yields would start moving lower ahead of a Fed decision to cut interest rates. In any case, a Fed decision to cut interest rates would take at least another 2 to 3 months. It could be slightly earlier than that also. But we believe that as far as the US economy is concerned, there is gradually emerging a scenario which would require the Fed to cut interest rates. Now, in the last FOMC meeting, though the Fed left the base rate unchanged, there was a tinge of softness in the Fed's last policy statement, because the Fed has been looking at quantitative tightening, but the Fed has decided to reduce the balance sheet reduction plan. They have decided to go soft on that, and they have reduced it from 60 billion US dollars to 25 billion US dollars. So that reduction of their market operations and decision to reduce liquidity at a slower pace from 60 billion US dollars to around 25 billion US dollars is an indication that the Fed believes that they need to leave sufficient liquidity in the system. So there is a tinge of soft money policy in the last FOMC statement, which again could be read into as an indication that even on the base rate, there could be some changes or easing of the base rates as we progress over the next 2-3 months.
Dr. Joseph,
Yeah.
in your last interaction, you indicated that large caps and mid caps hold better value in relation to small cap portfolios. Can we consider small caps now?
Yeah, in the last interaction, the circumstances which led to the conclusions last time, those circumstances haven't changed at all. Small caps were less preferred because small cap valuations had gone up against a sustainable long-term PE in the range of maybe 19 to 23. The small cap index PE had moved up to around 29 to 30, 31 levels. So that segment of the market became quite expensive. And in fact, you may be knowing that the Reserve Bank of India and AMFI had asked for a stress test of those small cap portfolios and mid cap portfolios to see whether everything was right. Also, almost a significant part of the monies which have been moving into the markets, both in mid cap, into the markets, into equity markets, the destination was mainly mid caps and small caps. So a lot of money has moved into mid caps and small caps, and because of which small cap market capitalizations moved up. Mid cap also moved up. Therefore, on a relative basis, we found that small cap segment was pretty expensive. Therefore, if at all someone is investing into small caps, invest in a phased manner. in a graduated fashion. The large caps continue to be looking relatively cheaper to buy based on long-term valuations. And the mid caps too, though they have also moved up or run up. From a longer term investment perspective, where one needs to harvest growth and through that much higher returns, mid caps continue to be one of the spots which investors could focus on to get better growth for the portfolios. That is broadly the prescription that we have been suggesting to investors. Also, it is very important to note that we have two MPC meetings over the next 2-3 months. We have two FOMC meetings coming up over the next 2-3 months. We have the general elections, which is on at this point of time, and we'll get the results in the first week of June. We'll also have the full-fledged budget, the first budget from the new government in the first week of July. So these are all factors that we need to keep in mind while investing into the equity markets. So it makes immense sense to do investments in a graduated or phased manner so that we cover all these events and also capitalize on any corrections that the markets would afford us over the next 2-3 months or 3 or 4 months. So that's the prescription and the view at this point of time.
It's always a pleasure, and thank you so much for these wonderful insights. Thank you, viewers, for joining us. Good day.